volatility. And even with volatility, equities by and large have had extremely meaningful gains over the last couple of years. Now we've finally started to see a bit of a correction, but still we've seen extremely strong gains. While real estate over the last 3 years has been it's been in a tough stretch. We haven't had we haven't had assets trading, and you have operators that have access to capital that are not in a position to where, oh, we have to fire sell a product. Now, many of them, ourselves included, and many of the private equity structured real estate operators, they're feeling the impact of the market and their assets are not tradable, but because there's no buyers in the market, but there's a need for capital in the assets because of the debt markets and things like that. And so obviously with private equity, you want to move your assets and you don't want to be holding for 10 plus years. But needless to say, real estate's been in a really tough stretch. So why do investors, what gets an investor bearish on real estate right now when often opportunity is created in those tough spots? So how does an investor really get over that hump and become bearish on real estate when they're looking at the tough stretch it's had for the last couple of years and equities have been so strong?
We've talked about that before on episodes. It's simple behavioral finance. People tend to be very myopic as it relates to their investments. I talked to a number of investors just today that we were talking about overall allocations because it is easy to get discouraged, even bearish on real estate as an asset class when you've seen the equities markets perform significantly over the past several years. And why would I want to reallocate a portion of my assets that have performed well and move those to an asset that maybe has had some challenges over the past couple of years? When ironically, that is exactly what you should do is buy high or buy low, excuse me, and sell high. So it's very easy to get discouraged, but also when you kind of think about overall investing, this is where it's important to look at your overall allocations. And one good example, I'll use a technology stock for one of our investors that I spoke with. They have not changed their allocation to that at all, and it ended up being somewhere around 5% of their total holdings. Again, they didn't change anything, they didn't add any, they didn't take anything out. And when they did a review of their portfolio a week ago, that technology stock that made up about 5% of their portfolio now makes up about 20%. So one
So,
fifth of their portfolio.
well, and they're using that, and that's based on because of the strong earnings they've had in the equities market. I know you had your calendar absolutely full today. Mine was pretty full, and I talked to a potential new investor, guy out of New York, this morning. That he's a young guy, late 40s, had kind of the executive path. He's been an executive for marketing for a number of different companies, large companies, and he finally decided he's going to kind of take a step back, and focus on allocating capital and building his investment portfolio. 8-figure net worth guy, and done fairly well with investments. He he has been the beneficiary of the equities market for the past 3 years and the strong climb that it's had. Not been dumping a whole lot of money in more recently. He has been more allocating to real estate liquidity events that he's gotten. But now he's at a point to where he was like, look, I'm so heavily allocated in the equities market. He sat down with his financial advisor, and his advisor was even like, look, you're playing with double house money at this point. Like, let's reallocate. And so he sold some of his earnings only, liquidated about 1.5 million, and then left the remainder of his capital, original invested capital, plus still some earnings in the equities market, and pulled a line of credit against 50% of the remaining earnings that he had in. And so pulled another line of credit of about $1 million. So between what he sold on gains plus the line of credit that he pulled at 6% interest, he's got $2.5 million to allocate into real estate with only 6% interest against $1 million of it. I'm not giving financial advice by any means at this point. This was a unique and a strategy that some people use. But he's got $2.5 million of ultimately house money that he's deploying at this point and using a little bit of leverage to arbitrage. So now the blended cost of that capital is not 6%. It's closer to 2.75. If you apply the cost of that capital across all 2.5 million that he's deploying. And now his cash flow that he can generate, if he invests in real estate that generates 3 to 6% in cash flow, just a measly 3% to maximum 6% in cash flow. It covers the cost of his debt, if not by double. And he gets to partake in the equity that's bought at the beginning, like we always talk about, the appreciation on the asset, and the tax advantages that come with real estate. So now he's hitting on all four of those keys that I talk about oftentimes as it pertains to real estate. And so, I think that's where a lot of investors right now fall short-sighted, and they look at, oh, we had 1,000 point run up today on the Dow Jones. Let's stay focused on that. Well, yeah, you're winning. Don't be the person on the cruise at the casino that's up 5x and decide that you're going to keep gambling and you end up down 10x. It's time to take some chips off the table.